Let me just make sure that everything is working. Wonderful. Okay. So, hello guys. This is me, Mr. Omar. And I apologize about what happened with Friday. I really got caught up and I thought that the lesson was at 1 o'clock. So, I've decided to make it up to you by making you a video lecture that you could watch from the comfort of your homes. This is not the first time that I've done something like this, as some of you might recall. I did this once with the accounting when I first came, and it got some good reviews, so I'm going to do it again now. Now, today we are going to be talking about something called corporate governance. Now, as we've discussed before, we have the issue that when you have a company, it needs to be managed. There's something called the board of directors. There's the CEO, there's the manager, there's the president, and then there's the bylaws of the company that control it. That put the laws that regulate it. Now, a lot of companies are run by the owner. If you own a store, if you own, a small company, or import and export, or whatever it happens to be. But a lot more companies are run by what we call agents. Agents are the people that we ask, that are people with more management experience, with a little bit more knowledge about the industry, about how to run a business, about how to get excellent results, that the owner or owners of the company, because in most cases this is then with shareholders, trust this agent with running the company, with managing its money, with controlling basically everything. And this comes up with a huge number of ethical implications and problems that pop up. Now, some of these have been solved to an extent. There is now a basic structure for the bylaws of a company. It's now generally known and accepted certain aspects that you follow when you're talking about corporate governance. But ultimately, it's still very confusing and a very big problem about how to deal with these people, about how to entrust your business with someone else. All of these issues will be discussed in this chapter on corporate governance, disclosure, and executive compensation. Now, we have now an issue. This might not be as common in Egypt, but around the world we've had a lot of corporate scandals. Among them, for example, was HSBC. Now, HSBC was found that it was laundering money, helping terrorists, funding shady operations, almost dealing in drugs, etc., etc., etc. I mean, unbelievably gross ethical violations of the law, of morality, of everything. So who's accountable? I mean, naturally, if you have someone dealing with drugs or supporting terrorism or whatever it happens to be, immediately he goes to jail. What happened in this case was no one went to jail. Not a single person. The bank as a whole was fined $5 billion, and that's it. That was about their profit for a quarter. In other words, they were set back 3 months. That was the extent of the government regulation and the punishment on these companies. Now, this has to do with companies and law, but there's another issue. Take, for example, a CEO that gets paid maybe $100 million per year. Yes, you heard that right. $100 million per year. Goes about and does his business, ruins the business. The business comes crashing down, heavy losses, employees start leaving, high turnover rate, huge problems start coming, and he's still getting paid huge amounts of money. And then when he finally decides to leave and say, you know what, I'm not fit for this, I'm not good at this, I'm ruining the business, he leaves and he gets what we call a golden parachute. He's paid maybe $400, $500 million before he leaves the company. Does this make sense? Imagine the case that you're an employee working in this company, your pay was cut, your friends were fired, all of these problems are happening, the company is in huge financial problems, and the man responsible for all of these problems leaves, and because he left, he's paid $300–400 million. These are some of the issues that will be discussed. Now, in the case of Enron, and this is one of the reasons why I gave you this assignment to do, was that because it was so famous, and because it was so big, and because it had so many different implications, it ended up causing the U.S. government to implement something called the Sarbanes-Oxley Act. Sarbanes-Oxley Act was a law that said, basically put rules on corporations. It basically said that when doing your accounting, you need to do it in this certain ways. When you give a pay, you have to do it in these certain ways. When you're in the stock market, you have to disclose this information. You have to show your profits. You have to show your revenues. You have to show your sources. All of these different things. This was a reaction to the horrible disaster that came from Enron, and it caused a lot of actually marketing opportunities for accounting companies, but I digress. That's something for another day. Now, when it comes to the top management of the company, who are they accountable to? Some would say they're accountable to the board of directors. Some will say they're accountable to the shareholders. Some will say they're accountable to the law. But in reality, a lot of times they're not accountable to anyone. Like sometimes the board of directors will take an active role in managing them and keeping them in line. In many other cases, they won't. In the case of the shareholder, if you have, for example, the amount of shares are split across millions of people and each person has 0.001% of a company, and a large amount of these people who own shares either don't know that they own the shares or aren't interested in following the company, and all these different problems, how do you gather enough people in order to make a change in a company? How do you gather enough shares in order to say 30% of the shareholders say this is wrong, or this executive shouldn't get a huge bonus, or we shouldn't pay him $500 million, or whatever it happens to be? Finally, even after the Sarbanes-Oxley Act, the government laws regulating these aspects of the CEOs still aren't that powerful. So when it comes to managers, even though they'll have certain codes in the company will say that we must follow the strictest form of ethics, we must put the customer first, we must take care of the company and take care of the money, and any employee that has bad performance must be punished or must be fired or whatever. That's all fine for all of the employees of the firm, except for the top management of the company. Now, the Sarbanes-Oxley Act tries to require that a company show that it has a code of ethics for its senior financial officers. And if it does, it needs to talk about the code, and it needs to put a code if it does not. And this goes into the whole debate that we had before about, the kind of capitalism or socialism and so on. Does the government have the authority? Does the government have the right to tell companies how to act? I mean, ultimately, there is the law. If the companies follow the law, then they are doing something good. If they do not follow the law, they are doing something bad. When does the government begin to enter into ethics? Now, naturally, if this was a real lecture, we would be having more of a discussion rather than just a one-sided conversation. But these are all questions that I want you to stop and think about. When does the government go into a code of ethics or some kind of morality when it comes to the company? And this even is an ethical consideration that how much should the government transgress on the rights of the company? Once again, I don't have the answers. No one technically has the answers. Even in all the textbooks of business ethics and all of the people who work in who are focused in research in business ethics, they don't have strictly proper answers. They do not say that if the solution must come from this way. A lot of the solutions are culturally sensitive. What may work in Europe might not work in America. What might work in Egypt might not work in China, and so on. But the first step into solving these ethical dilemmas, into solving these problems, is recognizing that there is a problem in the first place. And there definitely is a problem. Now, as we talked about before, you have a corporate board or a board of directors. Now, this board is supposed to oversee the management by the executives. But ultimately, that may have some kind of impact, and they've been around for a long time, but once again, has it brought about incredible results, these additions in the law about the management? Not necessarily. However, one of the aspects that have had a very powerful impact on corporations, on business ethics, and this is perhaps a tenet of democracy even, is the idea of transparency. Now, whenever you have a democratic society, you have politicians that are in the public eye. Whereas, for example, in something like in a dictatorship, you'll have very few people will ever see the dictator or the president or the king or whomever it happens to be. Decisions are made without the people's knowledge. It is something that is just taken at one point and people have to obey. In the case of a democracy, you have politicians, you have a president, you're always seeing them, they're always giving speeches, they're always in the eye of the crowd, they're answering questions, they're really getting involved with the people. This comes down to transparency. Whenever they take a decision, everyone knows about that decision. And when you are transparent, you are more likely to do what is right. For example, if a politician has to regularly disclose his financials every month or every 3 months, what are the chances that he will accept the bribe and just put it in the bank account? While it might not necessarily completely stop his taking a bribe, it will still limit the options that he can do. He knows that his bank account is in the public eye. He knows that his financials are constantly under public scrutiny. So he knows all of this. So he has to think once and twice and 3 times and 4 times and 5 times before he takes a bribe. Now, I'll give you a little bit, as I said before, about the Enron scandal, but once again, this is something that you are supposed to be researching, you are supposed to be talking about. But ultimately, it had something to do with accounting. They were fudging their accounts in order to have, to show greater profits on their balance sheets, to give more to get more investor confidence, all of these different things. If the Sarbanes-Oxley Act was around before Enron collapsed, it would have forced the company to give more accurate results. It would have forced the company to follow better accounting practices. It would have forced the company to disclose a lot more financial information. So, what would have been the result? The result is that financial losses would have, 1, been caught earlier. 2, stockholders would react, and perhaps negatively, and the company would have lost value. But then 3, stockholders would have then said, all right, the CEO isn't managing the company well, there are problems with the company, there are all these issues, maybe we should change the management, maybe we should do this, maybe we should change the direction of the company. While at the same time, the top management of the company, when faced with the reality that all the stockholders know about the bad financial decisions and the bad financial situation of the company, he from himself will want to change the situation. He will have more of an incentive because, once again, the issue has become more transparent. The issue has become more in the public eye, and thus he is forced to take something. So the information that a corporation is morally obliged to disclose coincides with much that is legally required. In other words, there are now laws saying that when you do your accounting for the company, it must follow these standards. It must account for assets in this way. It must account for liabilities in this way. It must account for debt in this way. It must account for capital in this way. Everything must be accounted in a way that is very acceptable to the latest and best accounting practices out there. By doing this, you ensure that when a company releases its financial statement to its stockholders, to its shareholders, people will take it and they will have accurate information. And then I could say, as a shareholder, either one, the company's doing good, maybe I'll continue to invest, or bad, the company's doing bad, I will pull my money out. And from that, actions and reactions ensue. Now, this comes down to the idea that each person has the right to access the information he needs to enter into a transaction fairly. In other words, if I am to buy a product, I know what product I am buying. If I buy, for example, a computer, I know that this computer will come with a case, and I know that it'll come with a CPU chip, and I know it'll come with a monitor and a mouse and a keyboard. I don't buy a computer and then suddenly one of them might have a mouse, one of them might not have a keyboard, one of them might not have a monitor. I don't know. I just, I buy a box and I open it up and God knows what pops out. Stock is a very similar concept. When I buy stock, I should be legally allowed to access all information that concerns me. When I'm buying a part of the company, I should be able to know, is the company financially successful or is it financially in a bad shape? That way I can know whether the value of the stock is good or the value of the stock is bad. If the company is lying to me about its financial situation, that causes a lot of problems for me, the shareholder. And then once again, that ends up reflecting on the company when and if, or if and when, the company is exposed, such as with Enron, that at some point these bad financials are exposed to the public. Rather than being a gradual decline that can be reacted to, it is a sudden decline that could actually destroy the entire company. So the Sarbanes-Oxley Act says that shareholders, people who enter into the transaction, who buy a piece of a company, have the right to accurate information. The second part is each person has the right to know that actions of others will be seriously and adversely affect him. In other words, if the board of directors takes a decision, I have to know that decision. I have to know, in general, I might not need to know the specifics. I know that there are secrets in the firm. I know that not everything will be known to me. But if, for example, if Apple suddenly decides we're going to stop selling iPhones, I, as a shareholder, will say, that is a really stupid idea. I'm selling shares in your company. On the other hand, if I don't have access to that information, if they do not tell me beforehand, I cannot react, and then suddenly the price of my share will plummet, and I will lose a huge amount of wealth. Because that's a really dumb move. Why would you stop building an iPhone? So the idea is that there are certain actions which might, not necessarily have to, but might seriously and adversely affect me, and I have the right to know. Now, if you'll recall, the previous slide, we were talking about morality and how a company should have a code of ethics for its management. And that's something very, abstract. It's just, you need to have a code. What will the code do? I don't know, but it needs to have a code. In this case, this is much more concrete, and this is, if any of you were to ask me, what is the solution for bad actions of the companies? I would say the action is to force more disclosure for public companies. I would say that it is to legally require information that is important for the country, for the government, for the shareholders, for the stakeholders to know. They should be legally required to give out that information so that, one, they can be held accountable, and two, the people who are involved can directly take reactions based on what exactly is happening. A transaction is fair if those who are a party to it have access to the appropriate information and freely enter into it. Now, what does this mean? It means that exactly what I was talking about before. If you have good information, and you know all of the things about the company, and then I say, I like the company, I'm going to buy a share, that is a fair transaction. If I find a company and the financial sheet says that it made a huge profit, but in actuality it made a loss, and I bought a share, that is an unfair transaction. Now, remember how we were talking about that the company should be transparent. It should disclose its information. It should disclose what it has and the information that is important to the public. Now, does that mean every company should do that? No. Why? If I have a family-owned business, the only people who should know what's going on, basically, are the family. Maybe they could include it to the workers or the employees in the company, but ultimately, the people who own the company are those that are most important. Followed after that by something like the government when it comes to collecting taxes and seeing if they follow regulations and so on. The companies that usually are subject to a lot more regulations and should be subject to a lot more regulations are public companies. Companies that are listed on the stock exchange. Why? For two reasons. One, it has a huge amount of investors. The investors could be in the millions. The investors could be in the tens of millions. And all of these people have a right to know about the company that they own a piece of. On the other hand, the publicly listed companies are usually larger than individually or family-owned companies. Most of the multinational and global companies are all publicly listed on the stock exchange. So when you have a company of that size, any ethical or unethical action could have huge, wide-ranging consequences on the economy, if not just on a country, but on the entire world. A very good case of this was Merrill Lynch, a bank that ended up going bankrupt, during the financial crisis of 2007. This bank did really stupid things. It sat and bought these really toxic loans. It took really risky loans. Anybody who wanted a loan, it just gave it out to it. And when something happened with the economy, when the economy started to go down, when problems started to happen, the bank lost billions upon billions of dollars until suddenly it went bankrupt. What did that result in? It resulted the biggest liquidation, or the biggest bankruptcy of, I can't remember if it was a bank or a corporation. I believe it was a corporation in the entire history of the world. If I remember correctly, it was bigger even than Enron. That shook the entire financial industry of the entire world. Now, had there been stronger regulations during that time, now once again, this could be disputed. Some people could say, even every time you put regulations, companies find a way around it. They have really good lawyers, they have really good whatever, so they'll find a way around it. But the idea is if you had effective, good regulations that were actively monitored and used at that time, they would not have taken such toxic acids. They would not have been so reckless. They would not have been so irresponsible. The company would still exist today, and the financial crisis, while it might still have happened, it wouldn't have been nearly as bad as before. So the main companies that are affected by these regulations and these things about the corporate governance and corporate governance laws are usually publicly listed companies. But once again, they still apply to the smaller companies. These things, these laws are made to affect or to help the shareholders, the board of directors, the workers, the government, the suppliers, the consumers, and the general public. In other words, all of the stakeholders. Anyone who is directly or indirectly impacted by the performance of a company have the right to at least know certain aspects of a company. If I deposit money in Merrill Lynch, and then afterwards I end up finding out that it went bankrupt, why am I to be held responsible? Why is my money to be lost? Because of the incredibly stupid decisions that some CEOs or the board of directors or the management made in the company that I had no prior access of knowledge to. Now, if I had prior knowledge, if I knew about what they were doing, I could then make a decision. One, it's a good company. Two, it's a bad company. And then that is up to my knowledge, my information, how well I've studied the company, etc. When I don't even have access to that company, then I am unfairly put in the situation that I can potentially lose a huge amount of money from what this bank did, even though I know nothing about what happened. So we have the idea that shareholders, like I was saying, one of the most important things are the shareholders. While people like workers, employees, general public, and so on, it's important for them to have general knowledge. Usually the most important people to have this knowledge are basically two parties, the shareholders and the government. Shareholders because they own a piece of the company. They have a right to know what direction their company is going in. And then you have the government, which needs to know that its laws are being enforced, that taxes are being paid properly, that the general welfare of the public is being achieved. Ultimately, shareholders just need to know because, well, they need to know what exactly they're voting for. They need to know what the company is involved with. Are they making good decisions, etc. I'm not going to go into great details because it's really not important. Now, in many companies, the board of directors are legal representatives of the shareholders. What does that mean? It means that the shareholders, the people who own stock in the company, they choose the board of directors. Kind of like in a country where you have a president, you have a prime minister, and then you have the House of Representatives, or you have the Majlis al-Shab, or whatever you want to call it. And you have this Majlis al-Shab, these People's Assembly, are representatives of the people. They represent the people. What does that mean? I live in El Abur, I live in Shubra, I live in Rul Farah, wherever it happens to be. I live here. Here has problems. It is being impacted badly by pollution from coal. My representative from this area goes to the government, tries to pass a bill saying there is pollution harming my area, my representatives are having problems, we should eliminate the pollution in this area. Something like that. On the other hand, if you have, for example, in general of the whole company, of the whole country, and for example, fuel subsidies are to be eliminated, and it's going to really hurt this state really badly. My representative goes, talks to the government, says, this state is going to be hurt very badly, it's going to be bad for the economy, we shouldn't remove the subsidies. He's a representative of the people, he speaks with the people's voice. A board of directors is similar. They speak not with the voice of the people or the public or so on, they speak with the voice of the shareholders. I own stock, I vote for my board. So they have two responsibilities. One, doing what is best for the shareholders, and two, reporting to the shareholders what has been happening in the company. And so, when it comes to the board of directors, they have a right to know the actions of a company. So if you have a board of directors that do not know anything about the company, and the CEO and the managers and so on will tell them nothing, then this is wrong, and in many cases should not be legally allowed. Finally, have the corporations, you have the consumers, you have the general public. Once again, because it has some things. If I have a supplier that is supplying and has a long-term contract with a company, and then the company ends up making some really stupid decisions and going bankrupt. Suddenly, I have a company, the supplier was assuming that it would have a long-term contract. Suddenly, the other company that it was supplying to goes bankrupt. Suddenly, it loses the contract. Suddenly, it's hit financially. A lot of problems. General public can be hurt because of pollution, because of laws, because of the things that happened from Enron, etc., etc. Now, we go back to a very interesting ethical consideration. How to choose what the company discloses. Do they have to disclose everything? I mean, imagine if Apple had to disclose that it was working on the iPhone. All the companies would suddenly jump up and start copying it before it even came out. There are certain secrets that a company should have in order to maintain a competitive advantage. There are some things, even when it comes to the financials, that the company does not want its competitors finding out because that could hurt it and its shareholders adversely. So what should the companies be forced to disclose? What should the company be forced to tell everyone, to disclose to its shareholders, to the people, to its competitors, that will ensure that the company is accountable, but at the same time not harm the company that it's giving away vital information? Now, a lot of this actually comes down to the field of accounting, believe it or not. Accounting has a huge role in ensuring that information is accurate, and also in terms of what is important from a financial perspective, what is important from a managerial perspective, and so on. So, in my opinion, and this is usually the opinion of people around the world, is that if you are to have some kind of disclosure law, it should be done very closely in line with professors of accounting, people who are very familiar with the laws of accounting, people who are very familiar with what are the results of accounting, what should be in place, what accurately reflects information, and so on. But even there are ethical dilemmas as to what is too much, what is transgressing on the rights of the company, what is too little, etc. There are a couple of other considerations. I'm not going to go into great detail in this lecture. We've been discussing this concept a little bit long enough, but there's a couple of other things that I want to talk about. Among them is insider trading. Insider trading is illegal in most countries, and what it basically is saying that if I work at a company, I'm a manager in a company, and I know that the company is about to make this contract with this other big company, and profits will go huge, I'll make billions. Only I, the manager, have that information. Does the public have that information? No. Do the shareholders have this information? No. So the manager goes and buys a huge amount of shares. Then the contract is signed, it's shown to the public, the price of the shares shoots up by a huge amount, by 20%, 30%, 40%. The manager makes millions, and then he sells all his shares. Is that fair? Under the concepts that we talked about, that a shareholder should have the right to have information, that to be a fair transaction, he needs to know all of the information. So in this way, every shareholder should be equal in the information that they, if not have, at least could be able to have. How many people can be the CEO or the president of a company? Only one person can be the president and one person can be the CEO. So in other words, if a person acts on this information, the only person who benefits is only one person. That is not fair, that is not good when you consider justice, that is a lot of problems. So countries have put laws saying that if you have inside information about a company, if I work inside the company, I'm in accounting, I'm in management, I'm in whatever, and I have inside information that the public does not have access to, I am not allowed to buy shares in that company. Once again, I am not allowed to buy shares and profit from what happened in the company. Why? That is unfair, that is unethical, and thus it ended up becoming illegal. It is also equally illegal to give that information to someone else, a family, a friend, or whatever, for him to take that information and then buy the shares and profit when the shares of the company goes up. That is also illegal. Now, another problem and another reason why it is illegal is because imagine I am the manager of a company. I have two decisions. Decision number one, make and take an action that will be that maybe cause some losses in the short term, but be good for the company in the long term. Or option number two, do something that will make the share of the price jump up in the short term and will help me profit greatly if I buy the shares, but the company will lose in the long term. So I have two responsibilities. Responsibility one, as the agent that we talked about earlier, I am responsible for the company, responsible for making it succeed, etc., etc. And then the other thing is that I also have basically a responsibility or a willingness that I want to make money, I want to profit. So I have two options. Either one, I profit, number two, the company profits. By making it illegal for you to profit on the success or failure of the firm in that way, you remove the conflict of interest, and thus the manager should only choose the option that makes the company profit and succeed. One of the problems about the laws about the insider trading is mostly that it's very impractical to kind of regulate. How do you know that every single person in the company is not investing in the company or is not using their inside information or giving it outside? It's basically impossible. I mean, if I call up on the phone and tell my friend, hey dude, my company's gonna sign a contract soon, you should invest in it. How are the regulators going to find out? How is that going to be legally accountable? But in general, as is most things when it comes to business ethics, the placement of a law is usually generally accepted that is the right thing to do. The problem comes from, will the law actually make a difference? And that is a question that is yet to be resolved. As we talked about before, we had something about the managers, about the amount of money that they are paid. That a lot of managers take $100 million, $200 million, $500 million, and it's not earned. They failed. They did terrible things to the company. The company, such as with HSBC. In HSBC, to my knowledge, and I'm not 100% sure, but to my knowledge, the CEO and the manager and the president and all the people are still there. Even after they helped fund terrorists, even after they lost $5 billion when it comes to the government regulations, even though many different things. By the way, they didn't fund terrorists, they helped launder money to terrorists, which really isn't that much of a difference. But British Petroleum, when it spilled a huge oil spill in the ocean, it ended up paying over $20 billion to the American government to help clean up the oil that it spilled. Guess what? Its CEO is still there, and he's still being paid tens and hundreds of millions of dollars. So the shareholders lost a lot of money because the company had to pay $28 billion, but the CEO, the one responsible for them losing the money, is still there. Once again, what I was talking about is that sometimes when a CEO goes and leaves, they take $200 or $300 million or just this huge paycheck that they call a golden parachute, and it doesn't even make sense. Why would I give money to a CEO to leave the job? Why would I give them such a huge incentive? It doesn't really make any sense. And it's like, the idea is that already they made a huge amount of money, they can find a job in any company, why would we give them such a huge amount of money? These are the issues that we're talking about, and once again, this goes back to, this was one of the reasons why I talked about the economic and political aspect of ethics. When you talk about, is it ethical for the government to control companies, to control individual lives? When does a country overstep its boundaries? The country, excuse me, has responsibilities. And depending on the culture and depending on the country, they have different responsibilities. But two ethical dilemmas happen. One says that no, it's our right to do what we want. If we want to be unethical, that's our right. If something is illegal, then fine, the government goes in. But when it comes to something ethical or unethical, the government has no place. Who is the government to tell us what is ethical and what is unethical? On the other hand, the other aspect is in how do these laws be enforced? I mean, such as with the insider trading. how do I know if it's happening? Well, it'll happen on some high levels and some people will be caught from time to time. Ultimately, it's such a widespread phenomena. It's just something that cannot be regulated and cannot be stopped. It's impractical. And when I have a law that cannot be applied, maybe it should not be a law in the first place. These are basically the ethical dilemmas when it comes to corporate governments and corporate governance laws. And when the next time we look at a politician and he says that he's going to help regulate companies or he's going to control companies, or another politician that says he's going to reduce the regulation on companies and allow companies to be more free to make profits and improve the economy, think of the ethical implications. Think about the practicality of the first. Think about how is the first person going to regulate it? Is it going to hurt the economy? Is it going to cause some problems? Is he going to rely on experts and professionals and professors to make the best decisions, or is he just going to come up with some stupid law that makes absolutely no sense? Is the second one, the one who wants less regulation, is he going to do it in logical places that will really help job growth, or will it just be done in ways that will help companies do unethical actions that might hurt the economy and the shareholders and the stakeholders and everyone? That's about it for today. You now have a basic idea on the corporate governance. I'm going to soon be putting another assignment on the academic portal. Yes, I'm going to put another assignment on the academic portal. I apologize, but there needs to be at least four assignments by the end of this summer course. I will see you all, inshallah, on Sunday. I'm not sure of the time, but don't worry, I will not be late. I will be on time, and we'll get everything done, and everything will be hunky-dory and whatnot. There will be a quiz on Tuesday, and it will include more of the things that we took, about the legal aspects, about the economy, about the corporate governance, and so on. I'll be very soon putting up all of the summaries that I've been delaying putting on. I'll put it on either today or tomorrow, and you'll have access to all the information. Study, be prepared, and once again, for the millionth time, I do not care for what your answer is. I want how you answer. I want justification. I want logic. I want to see that you understand the implication of business ethics in this course, in life, in business, in Egypt, and in general, in society and all these other wonderful stuff. If you have any questions, just send me an email or talk to me Sunday. And I hope you enjoyed today's lecture, and I will see you soon. Goodbye.